everybody, and welcome to another episode of the Burn Your Boats podcast. It is me alone today, David Shaw. I will be presenting today's timely 15 type topic. And I always, when I was a kid, my mom used to always tell me if I had nothing nice to say nothing at all. And so when I feel that the environment is very rocky, very shaky, like everybody else, I take a minute. I don't want to come into the podcast and say, here's my theory on this or here's my theory on that until I have it fully formed. And so I thought today I would kind of reflect back at the last month or two in what I am seeing, what I am feeling, and what I'm hearing from other professionals that are out there trying to navigate what is and what appears to be a pretty choppy environment. And so I thought I would discuss the topic of just how do we steer through uncertainty, and what are the investment strategies ahead of us in this age of disruption? Because at the end of the day, it's not just, the political side. It seems to be a little bit noisy, if you will, but we also have AI sitting here right in front of us right now. And there's a lot of people feeling very uneasy, and there's a lot of people feeling very excited about AI. We also have tariffs and essentially an economic battle happening out there right in front of our eyes. And again, it all creates this sense of disruption. And when you have all of these things in your midst right now, a lot of people start to feel uncertain, that they don't really have a handle on how to move forward. And they kind of start to regress in their lives, looking for, running to safety. And I completely and utterly get that. I'm in real estate, and real estate is incredibly impacted by uncertainty on any level out there, because real estate itself runs on the bond market. The bond market is sifting through micro and macro data all day long to produce the yield concept. And so if there is uncertainty in the world, oftentimes my industry can have more favorable environments. Or if there is uncertainty in the world, sometimes in a completely different scenario, we can have a great deal of uncertainty in real estate also, because we just don't know how to plan our project. So look, overall, how do we stay focused on our personal goals, on our investment goals, on our business goals, amidst all of this chaos, the chaos of tariffs and AI, noise and stress? So how do we do this? So let's briefly discuss these current uncertainties and how they impact you, how they impact me. So tariffs, right? Tariffs simply create uncertainty because we have a global trading system. We have capital that is global in nature these days. And so when we have uncertainty in tariffs, we have right off the bat, we have increased costs. So if you're a builder, you're a developer, you're an Amazon drop shipper, or quite frankly, if you're anywhere in the global supply chain, you don't know what your costs are going to be this month or next month. Then you have supply chain disruptions completely, where shipping and shipping routes are being cancelled, where parts of your overall makeup of your car or of your widget, you get some of that widget from overseas. So you're going to have a supply chain disruption. Where are you going to get your next thing, your next input, right? And then all of that uncertainty creates market volatility. So now we have the cost, the disruption, and now we have this volatility. We don't know, if we're going to be able to sell our product at this higher price because we've got recessionary conversations happening because of the volatility, right? We don't live in a vacuum. What are the Chinese going to do? What are the Europeans going to do? They're not going to sit there and, just have their trading partners throw bombs at them. So they're going to have retaliatory measures in store, and that's going to impact farmers. It's going to impact the car industry. It's going to impact the energy industry. It's going to impact us in so many different ways when we talk about retaliatory measures, right? And then just overall, then people, with all of this being said, people then they don't know how to make their next investment. They don't know how to build that factory. They don't know how to build that next house or that next multifamily. And so all of this creates just these strategic shifts, right? And where we don't really know who the winners and who the losers are going to be as we go forward. And that's what we're going to try and unpack a little bit here today. But layer in on top of that we also have this AI, the impact of AI developments. So we've got tariffs and uncertainty on one side, and then we have AI on the other. And as a parent, I know I'm looking at my 3 kids. I'm like, what world are they going to be growing into? Because data itself and access to data is going to be less important. Even parsing information is going to be less important. Data itself is not going to be scarce. All of the data is going to be available to everybody, right? And so that brings a great deal of unpredictability to so many sectors of the economy, because AI adoption across industries right now, 70% of companies across various sectors are using AI to some degree, right? And, you think about AI in real estate alone, 62% of real estate firms are investing in AI technologies for property management, predictive analytics, customer service, and AI-driven platforms are enhancing transaction efficiency by 30%. So imagine for a moment you're in the real estate industry and you're reading that statistic and you're not implementing these AI-driven productivity technologies that can increase your efficiency by 30%. That's bonkers. And, there's a lot of companies that are striving to use these tools in one way or another. But do you really, really feel that you're using them to their most effective level? I know myself, I use AI in various aspects of the business, but I know also I need to lock myself into a room and stay in that room for 30 days, turn off my phone, and come out AI wise. And until I do that, I know there's areas of my business and there's areas of real estate that I'm not going to be able to embrace and enhance AI unless I take the time to step away for a minute and figure that out, right? So the global AI market, just in general, was valued at about $142 billion in 2023, right? By 2028, it's going to be $500 billion, $500 billion by 2028. And you think about just the operational efficiency of what AI is going to do inside every business, the medical business, the production business, the manufacturing business, the robotics business, the bioscience. It just keeps on going and going, right? So AI can improve business productivity by up to 40% across just general, efficiency across general businesses, according to PricewaterhouseCoopers. So AI in, let's say, again, back to real estate, AI in property valuation alone, 64% of appraisers now use AI-powered valuation models for more accurate property valuations. I think that that's bonkers, that we're moving away from, I know myself, I'm in the private lending business, and when a loan potentially comes to me, I know that I trust myself. I don't trust an AI model to do it. I'm sitting here, I'm looking at it myself, and I'm using my own brain power. But the concept that an AI is going to be able to do it better than me just scares me, if I'm just being perfectly honest, right? So think about if you're out there and you are in any business that has customer engagement. 80% of all businesses now using AI-driven chatbots report a 30% improvement in customer engagement and satisfaction, right? That's according to HubSpot. Now, they have a dog in that fight, but you still get the point, right? 80% of businesses using AI-driven chatbots report a 30% improvement. So the bottom line is this all creates uncertainty. And a lot of people right now are feeling like it's an economic shock, right? So, let's look back at the last time. And quite frankly, it is the last time we had a really big shock. And I'll talk about the real estate business. Obviously, in 2008, we had the most horrific shock into the system when the banking system itself started to fail in front of our eyes. Now, for most people who are in real estate at that time, that downturn had really started in about 2006. The market had slowed into 2007. And in early 2008, it was only then that the event was Bear Stearns collapsing and then the rest of the financial markets becoming very uncertain about how much bad debt other banks had on their balance sheets. But it didn't just happen one day. It happened because the market itself had been slowing for nearly 2.5 years by the time that happened. Now, I'm not predicting anything like that again, but I am saying in terms of real estate, I feel very, very similar in that the real estate market itself has been slowing down. There's been a large break on the real estate market, since interest rates rose, and we're approaching nearly 3 years of that now. So nearly 3 years ago, the real estate market entered a certain slowing or recessionary feeling, depending on who you are and what you do within the real estate market. So let's talk about some strategies, right, that really helped, investors weather those shocks and emerge stronger. Because everybody I know who really, really changed everything about their outcome and their fortunes in the last 10 or 11 or 12 years that was involved in real estate during this time, they came out 10x stronger, 100x stronger from the financial crisis of 2008 and 9. So I want you to think about that. The people who were involved in it, the people who were being hurt by it, the people who had to navigate it, they're the people who became the millionaires and billionaires in the last, 13 years of real estate. Why is that? Why is it that the people who were kind of most impacted were the people who made the most out of the next 10 or 11, 12 years? And the people who the meerkats, climbed into their little, into their hole in the ground, covered it up, made sure they didn't get hurt. Those folks weren't really in a position to really scale out their lives after the shock had passed. And so let's just talk about what strategies these people had, right? So, the US housing market, it really began to recover in around 2011. So if 2008 was the shock, so that's what most people would have seen. They would have seen 2008, like late 2008, 2009, 2010. During that time, you could buy houses all day, but there were zero people buying them. And so the housing market itself didn't really show a recovery until 2011, right? It really hit a bottom statistically at that time, late 2010, early 2011. And home prices started to increase as foreclosures started to decrease, and lending standards themselves began to ease. Because remember, in 2009 and 2010, the banks and pretty much all creditors pretty much closed up shop. So you might say, oh, I want to go back to 2008, 2009, or 2010 and buy a lot of real estate. Well, I hope you had cash on hand, because the banks weren't providing any liquidity whatsoever to investors. And so investors who were geared up, they were ready, and they were tooled up, and they understood real estate, were starting to get pretty active by 2011. And then home prices really started to increase at that point in time. Places like San Francisco, Denver, Dallas, these cities experienced a really sharp rebound. Now, why? Strong job growth, limited housing supply. These were cities that didn't really have a great deal of building in place prior to 2008 and 9. And they weren't classic Sunbelt cities. The cities that really got hit hard were places where there's a lot of land and there's a lot of building. Places like Phoenix, Florida in general, but not all of Florida, like the downtown cores, not so much, but definitely out in the outer suburbs and where a lot of home builders are. And even within Los Angeles, big areas of LA had very, very sharp decreasing in pricing, but there were always hot spots. So I say San Francisco, Denver, Dallas, just to name a few. But there's something that was true almost in every market of the country, right? And that is higher income households. They recovered the fastest. They're more resilient in downturns and negative financial situations, right? So according to a 2014 Pew Research report, families earning over $100,000 saw their home values rebound more significantly than lower income households, right? And so that was very obvious to me. The neighborhood I live in, the neighborhoods the people I know live in, they bounced back quickest. They were only down for a year or two. They were hard pressed for a year or two, for sure. But the rebound was, not only was it sooner, but the rebound was also very significant. So much so, I would say most of the rebound had already occurred by 2013 or 2014. Okay. Now, where was the slowest areas to recover? You guessed it, low and moderate income households face the slowest recovery. Many households are impacted by, prolonged unemployment, very much impacted by stricter mortgage lending practices. So homeownership rates among these groups remained almost stagnant for years and years post-crisis. And I know that because I was working in these moderate income type neighborhoods for a while. And that's where the opportunities for buying distressed homes and making them pretty again and putting some tenants in, that's where that market was most resilient, right? And so any investors back then who are focusing on like buying foreclosures or distressed properties during that downturn really benefited as prices began to rise. Okay, according to CoreLogic, those who purchased foreclosures in the later years, 2012, 2013, saw significant appreciation in value even by 2016. Now you think about what's happened since then, right? So as the economy started to improve back then, job growth picked up, housing demand surged, leading to increased house prices nationwide. House values increased approximately 6 to 8% annually from 2012 onwards. So think about that. Every year since 2012, 6 to 8% of just appreciation, with some markets experiencing even higher appreciation. Now, I'm in the Tampa market, and I can tell you our appreciation was well over double digits for, I'm going to say, the last 10 years, if not longer. Okay, so that homeownership rates for higher income households returned to a pre-crisis level very, very early on. And so as we go through this uncertainty, use what we've just said there, because these data points to kind of illustrate how recovery was not uniform, it's not uniform and different. It's not uniform across the country. It's slightly different in different segments of the population. It's slightly different in different geographical areas. And remember that governmental actions, they're always going to play a role in certain neighborhoods and stuff like that. But how is this all actionable for you listening here today? And I'm going to give you a little rundown of a conversation that I had inside a mastermind group that I am part of, right? And I forwarded on a podcast to the group, and somebody asked me to summarize, what I was forwarding to them. And I said, yeah, sure. So this was a data statistic type podcast about real estate. And so I'm going to read out what I wrote to the group, and I'm going to read out one of the responses I got. I think you're going to find this interesting. So here we go. Okay. So higher interest rates usually precede a housing downturn and recession as asset prices gets out of hand in expansionary periods. So what I'm saying there is we've just gone through 2020, 21, 22, 23, and we had an expansionary period, a real heavy expansionary period. And the Fed came in and introduced higher interest rates. We all know this, okay? So, but if you look back historically, higher interest rates are the tool that the Fed and indeed the bond market often use to slow down the economy. And these higher interest rates are usually an indicator that something is about to change in the market. So we had higher interest rates 2.5, 3 years ago. Look, the central bank mandate, the Fed mandate, is to slow something. It's to slow the economy until something breaks. So it's my view that we are mostly through this phase, painful as it's been for our industry. So the central bank mandate is to slow something until something breaks. It's my view that we are mostly through this phase, painful as it's been for our industry. So what I'm saying here is that the last 2.5 years have been real painful, but they're probably that's the pain we don't like, but we're probably closer to the dawn than we are to the downturn of our industry. So here we go. As we start to experience recession in the broader economic environment, regulators will stand by until pain and politics demand action. Historically, the pendulum swings back to a more accommodating policy. My view is that we are still waiting on this event. So it's my view that what could turn a mild recession into a maybe slightly deeper recession, we don't know what that is yet. I don't know if that event has taken place. I really felt strongly in the last couple of weeks that, tariffs might be that, and it's still yet to be really, known. If the event, something that creates broader market hysteria, is maybe that market sell off a couple of weeks ago, 2-3 weeks ago, maybe that was the event, right? Maybe it wasn't. But for anybody who owns a portfolio of equities in their retirement account, most people were licking their wounds there for a few days. And I guarantee you there's a fair few listeners listening to this right now who really had this sick feeling in their belly. It's like, oh my goodness, I'm down 200,000, I'm down 400,000 or more, So it is my view anyhow that we are still waiting on the event, or the event that I'm discussing has already happened in the last couple of weeks. But to highlight what has happened in the last couple of weeks, I write, in the 1980s, the Sell USA recession, bond yields spiked at that time. We would normally associate recession with lowering bond yields. This is still the likely outcome. However, until it does, it is prudent to proceed with caution on short-term capital projects. And so what we saw here a couple of weeks ago, we saw a broad market sell-off and we saw a bond market sell-off. Highly unusual. Highly, highly unusual. And that's the sell USA play, if you will. And so highly unusual to see a broad market sell-off and a bond market sell-off. And at that time, we were thinking, and the conversations in the economic environments were that this was the Chinese and the Europeans selling off their bond reserves. That's now proven not to be the case. There wasn't a broad market sovereign wealth and sovereign treasury sell-off. So I still don't know exactly what created that bond market surge recently, other than the fact that ordinary Joe Soaps on the street didn't fully believe that treasuries for a minute were safe. Okay. So I think we have some stability behind that. However, here's what happens. So I'm telling my friends here inside the group that it's probably prudent to proceed with a little bit of caution on short-term capital projects. That's like starting new subdivisions, starting new home builds, and starting new big heavy capital projects. I bring this home to the conversation. Home sales activity does not, in fact, correlate with recessions. Did you know that? Because monetary policy and M2 money supply, that's how much money the Fed create each day, each month. So monetary policy and M2 supply tends to be more accommodative. Sales volumes rise during downturns. And so the historical pullback in activity seen in the last 2 years may soon reverse as soon as recession fears move the Fed and the bond markets in our favor. Buyers are on the sidelines. So my take on the market right now is that buyers are on the sidelines. We are waiting for lower interest rates. And where do lower interest rates come from? They come from broad market recessions and panicky events. Okay. So we are waiting for a broad market recession. The housing market statistically does not, home sales, as soon as rates go down in any recessionary or non-recessionary environment, rates go down, house sales activity increases. So it is likely that home sale activity, recession or not, in the next year or two is likely to start increasing. So anybody out there right now that thinks the future is going to be, for real estate investors, is going to be less bright, I would argue that we're probably already through most of the downturn in sales activity, because buyers are not going to stay in the sidelines forever. So my takeaway is to the group. My takeaway is sharpen our pencils, hone our skills, prepare for expansion now. We have been experiencing these headwinds for some time, and as the news gets worse, keep an eye on the Fed, keep an eye on the M2 money markets and bond yields, and know when it's time to really get moving. Now, so that was my input into the group. So, get ready, sharpen our pencils, be ready to take action. And here's the response that kind of summarizes this whole conversation. All right, David, I got the axe to the grindstone myself. I'm still building and scooping up land. I've always believed and witnessed the ones who plant when times are tough are the ones who prosper when the season shifts. By the time the risk-averse start to build, the real harvest has already begun. Of course, everyone has their own risk tolerance, and while we should be cautiously optimistic and avoid getting out over our skis or over-leveraged, I am bullish on the future of the properties we are now permitting right this minute. So, what do we take away from all of this, right? We know that recessions tend to be short-lived. We know that there is opportunities when there's negativity out there, but those opportunities are only really available to the people who are always taking action. I own a real estate portfolio, right? And I look back at everything that I own, and people say, oh, house prices are going up or down. I don't really care because they're all rented. You know, I put two houses on the market about, I'm going to say 6 days ago, and I could have rented them 10 times over. And this is inside, this is here in the St. Pete area in Tampa. And everyone's out there telling me housing market taking a dive or so much more overbuilding, rental market is soft. I can tell you it's not, and all I care about is that my properties stay occupied, so the income keeps on coming in, so I can pay off my mortgages, and slow and steady by paying off mortgages, and um, understanding that inflation is here and it's not going to get any cheaper to build houses in the future. So the reason for recording this today is to really encourage you to think about your own life, think about your own future. If you are paralyzed and you're sitting on the sidelines, you're probably not going to be in a position to do very much when the opportunities do present themselves, because you're probably still going to be feeling paralyzed. I would encourage you to look out there in the market. I sat with an investor yesterday. He pulled out his phone. He, looked at a distressed property in front of his phone. He found that investor's number right in front of my face. I made a phone call, set up an appointment, and he said, I'm going to buy that house today. The whole thing started, took place over a 6-minute process, right? So he might make $30,000, $40,000, $50,000 by doing that. So if you're still with me, recessions, noise, AI, downturns, they're all just part of being alive, right? I just gave you examples of, something that happened like 13, 14 years ago. And so as we navigate very uncertain times with AI, because that's some stuff for sure. And with tariffs and with the political upheaval and with retaliation and this, that, and the other, focus on your economy, because real estate, and we're real estate guys here, has just experienced about a 2.5-year recession because of rates. And we're finally at a point now where, depending on your market, we're at a point where, there's not equity floating around everywhere. We're not seeing that much price decreases anywhere. Certain markets are a little bit more supply than others. But I'm telling you right now, that supply is going to get mopped up, because that's where the supply is going to be as soon as buyers come back into the market. The supply is not going to be in the undersupplied areas. The supply is going to be in the well-supplied areas. So that's going to pull people into those areas. So anybody who is looking at their investment right now and they're like, oh, my market is down by 4%, 5%, or there's a lot for sale in my market, I assure you that inventory is going to get mopped up over the next year or two. Know that when it feels most uncomfortable out there, know that is when you probably should be doing things. It's probably when the opportunities are actually presenting themselves. And so as I go forward in the next year, and as I go forward on, in the short term and the long term, as I go forward in the long term, I don't have time to waste. I'm 53. If you're 43, you're going to be 53 in 2 seconds. Your investable timeline in your life, the time when you've got a job, you've got the know-how, you've got the cash on hand, and the market is super rosy, that's quite limited, right? When you're looking for just only sunny upsides. So you have to, in your economy, stay consistent. Do get a little bit greedy when you see opportunities. Don't stand on the sidelines. Be careful of gimmicks. Be careful of people gimmicking you into, paying retail prices for things where you don't have to. There's a lot of deals out there at the moment. And so with that being said, go get those deals. Pick up the phone. Learn how to underwrite. Because there's probably, as far as I can see, in the next year or two, or three. Now, there may be one more, two more big shocks that come along, but know those big shocks create lower interest rates, and lower interest rates will create more demand. So it mightn't be rosy the day that you buy your investments, or it might not be, but I assure you, over time, and you play the long game, you don't really have to worry about AI with housing. You don't really have to worry about, tariffs 5-10 years from now. Pretty sure it's all going to be ironed out. And you will have a real estate portfolio that creates significant wealth for you that you can use to take out, equity whenever you take a loan out, whenever you want any kind of capital injection in your life. So don't spend your life sitting, worrying, and reading the newspapers all day long. We've just laid out a pretty decent argument that the people on the ground are still buying land. They're still, they're still putting permits in. They know that the market's uncertain. They know that tariffs might bring their build costs higher. They know that inflation could take off again, but they're not standing still. They're doing things. And I guarantee you they're going to be the winners in the future. So if you want to be a winner, stop trying to plan everything and rationalize with yourself why you shouldn't do things. The people who are really, really doing things are out doing things and are not talking about tariffs, I assure you. So with that said, thanks for spending this time with me. I hope you enjoyed it. And I look forward to talking to you next time on the Burn Your Boats podcast. Thank you so much for tuning into today's episode. Look, we truly appreciate your support and hope you found the conversation insightful and engaging and useful. If you enjoy the show, because there's a lot of shows out there, would you please take a moment to rate and review us on your favorite podcast platform? Your feedback helps us grow and reach more listeners. And if we reach more listeners, we will have bigger and more interesting guests. Please go ahead and subscribe so you don't miss the next episode. We hope you enjoyed today's show. Thank you so much.
You've been listening to the Burn Your Boats Wealth podcast with Clark Lunt and David Shaw. We would love to hear from you. Please reach out at contact@burnyourboatswealth.com with comments, questions, and if you have a topic you would like Clark and David to discuss on an upcoming episode. We would very much appreciate it if you took the time to rate and review Burn Your Boats on your favorite podcast listening app, and make sure to follow and share on social media. Content in Burn Your Boats Wealth podcast is for entertainment purposes only and is not legal or financial advice. Please review our legal disclaimer at burnyourboatswealth.com. Thank you and have a great day.